Welcome to this week's edition of the Echo45 Advisors Weekly Market Update. I'm James and I'll be stepping in for John this week. In this video, we'll discuss the recent underperformance of the information technology sector and the broadening market rally. The fact that a handful of AI-related stocks have driven market returns over the past few years has raised concerns about the sustainability of the market rally and the potential risks of outsized valuations. Over the next few minutes, we'll talk about sector leadership rotation over time and the importance of maintaining market exposure across many parts of the market. First, the information technology sector has underperformed the S&P 500 so far this year, as shown in this chart. Meanwhile, sectors like financials, materials, and consumer staples have begun to catch up. This market rotation reflects concerns about high valuations, elevated interest rates, and AI investment uncertainty. For instance, the S&P 500's price-to-earnings ratio is currently at 22x, near the dot-com peak, while the technology sector has a PE ratio of 27.7x. Historical patterns show tech sector volatility is common, from the 1960s quote-unquote tronics boom to the 2000 dot-com bust, emphasizing the importance of maintaining a balanced investment approach. Next, concentration risk is still a major investor concern. Concentration risk occurs when a portfolio is heavily weighted toward a particular sector, asset type, or small group of holdings. Today, some investors may unintentionally have an outsized weight in tech companies simply because they have outperformed in recent years. While this has helped many portfolios, it also creates challenges. Major market indices are dominated by tech companies, with the top companies, known as the Magnificent Seven, having an outsized impact on the overall market. This concentration risk may require investors to carefully monitor and rebalance their portfolios to maintain desired risk levels. Finally, this chart shows the difference between market-weighted and equal-rated returns over time for the S&P 500. It highlights that while large tech stocks have recently been significant contributors to index returns, this has not always been the case. Throughout history, a broad range of sectors have contributed to returns. For much of the 20th century, the largest companies were known as quote-unquote blue chips and were seen as boring, stable, and good sources of dividend income. Times have changed. Although AI developments are driving current market enthusiasm, it's also true that these breakthroughs could benefit all sectors and companies, just as the digital revolution has. Maintaining exposure to many parts of the market may help capture broader economic benefits over longer periods of time. We hope you found this market update helpful. If you would like to discuss any of these topics in more detail, please don't hesitate to reach out to us. We look forward to speaking with you. Have a great week.